UPS is trading at a PE of only 19.9, which is a 20% discount based on their 5-year average PE of 25. But with the revenue declining year over year by 5%, are they still a buy? In today's video, we'll cover UPS's business operations according to their 10K, key fundamental metrics, and technical analysis. UPS operates a shipping network utilizing multiple transportation modalities, and they state that their services include transportation and delivery, distribution, contract logistics, ocean freight, air freight, customs brokerage, and insurance. Or in other words, they deal with all of the necessary logistics in order to ship packages. Although they state that their transportation services include ocean freight, they do not operate any ships within their fleet, but they do have 294 aircraft and approximately 135,000 package cars, vans, tractors, and motorcycles. They also state that they operate in more than 200 countries, but by revenue, they are primarily a domestic business at 79% of revenue, or $71.7 billion as of their 2023 annual report, while their international revenue is at 21% of revenue, or $19.2 billion. Now let's cover the macro level benefits or pros of buying into UPS. The first and probably most obvious pro is that they and their competitors are the backbone of the growing e-commerce trend. With more people continuing to buy online, this means more shipping volume for UPS and their competition. Speaking of their competition, they actually work together with one of their main competitors, Amazon, who is the largest e-commerce retailer in the United States by a huge margin. As of 2023, 11.8% of their revenue is derived through Amazon, and this percentage of revenue has remained roughly stable over the past 3 years. Although we'll come back to Amazon in the risks portion of this analysis. Another major pro to UPS's business is that they operate a shipping network. Their well-established network inhibits new competition as it takes time and consumer confidence to build a new network. Another potential pro is the growing trend of automation. Automation is already implemented in their shipping process, and in the not-so-distant future, they may be able to reduce their employees and replace them with autonomous delivery, or replace other currently humanized components of the shipping process. After all, they are simply moving objects from one place to another. Although part of their cost efficiency is delivering multiple packages along a single route, which may be challenging to overcome by using drones to deliver each package, for example. The last major benefit to their business is that they operate with their competitors a distribution oligopoly in the United States, along with FedEx, the United States Postal Service, and Amazon. There are very few competitors that operate at the same network scale as UPS, and this is unlikely to be disrupted overnight. Now we'll look into the macro level cons or potential risks of their business, and there are quite a few to consider. The first is that Amazon is continuing to gain market share in e-commerce. And while UPS does work with Amazon, Amazon is growing their own shipping network and phasing out other distributors whom they work with, which has clearly been one of their goals. I remember a time when UPS was selling their vehicles to Amazon and they were haphazardly being rebranded with the Amazon logo. Now, Amazon's network has been substantiated. I don't know about you, but I wouldn't want Amazon or Jeff Bezos as my main competition. Another huge risk to UPS is that the American economy is struggling, and this is having a direct impact on their shipping volumes, which have declined by a whopping 8.5% since 2022. And potentially, the worst is yet to come, as interest rates are remaining high. Yet another downside to their business is that their fleet of vehicles is massive and costly to maintain and operate. Big vans and trucks like the ones UPS operates are generally inefficient in terms of fuel consumption and need to be operated by humans, which ultimately cuts into their margins and has to be pushed onto the consumer. Here we see their total operating expenses were $81 billion in 2023, while their total revenue was only slightly higher at $91 billion. Not that this is a true side-by-side comparison, but if you're considering investing in a shipping business, rail is far more efficient at transporting goods than semi-trucks, requires far fewer human operators, and also receives greater tax benefits from the U.S. government, which acts as a form of incentivization to use rail. On the topic of the U.S. government, one of UPS's main competitors is the United States Postal Service. This is a big risk, as USPS has been having huge losses in net income, which came to a total loss of $6.5 billion in 2023, which means that they're providing their shipping service at a rate that doesn't need to be competitive with the overall shipping market, as the American taxpayer will perpetually fund USPS, whether they are profiting or not. Now that we know the foundation of UPS's business, let's look at their financial metrics to see if they are running a sound operation. Here on the right, we see their total revenue since 2014, which has grown from $58.2 billion to $89.7 billion as of the trailing 12 months, which gives them a 10-year average growth rate of 5.3% over the decade. And if we compare that to their TTM growth rate of negative 9%, we see they are currently facing some significant headwinds. But revenue is arguably less important than the bottom line or their earnings per share. On the left, we see their EPS has grown from $4.75 per share to $8.01 as of the trailing 12 months, giving them a 10-year average growth rate of 8.2%, much better than their revenue growth. But compared to their TTM EPS growth of negative 34%, again, we see they are currently struggling. Looking at their free cash flow on the right side, the first thing I notice is that their free cash flow is quite variable compared to their EPS, which I generally don't like to see, although it is still trending in the right direction. The next metric we see is their shares outstanding on the left, which has shrunk by only 0.71%. Annualized. I like to use shares outstanding as a sort of canary in the coal mine, and if shares are increasing at a meaningful rate, I always determine this as a red flag, and a red flag means avoid. In UPS's case, their shares outstanding are still declining, so I take this as a fair sign of financial wellness. Now that we've seen their income statement, we can look at how they're managing their cash with their balance sheet through their total liabilities. Their total liabilities have surprisingly declined since 2019, which is almost never the case for dividend-paying stocks, and their current total liabilities are at $50.7 billion, or 8.6 times their TTM net income. And in terms of cash, they have almost 1 year of earnings on hand, so their debt level is quite high and is a red flag as a potential investment given their declining revenue and net income. Now we see their dividend payout ratio as a function of EPS on the left and free cash flow on the right. From 2014 to 2023, their average EPS payout ratio is only 52%. But their TTM payout ratio is much higher, 81% of earnings. Or if we look at free cash flow, they've almost paid out the entirety of their cash as a dividend, which is bad for dividend investors. Thankfully, this is not a business that needs to innovate to maintain its shipping network, and is more of a toll boost style investment. Now we see their dividend growth rates, which over 10 years has been 9.7%. The past 5-year growth rate was 11.7%, and the 3-year growth rate was a staggering 17%, while their 1-year growth rate was only 5.2%. These growth rates are too high considering their EPS has only grown by a 10-year average of 8.2%, and the recent EPS payout ratio has climbed all the way to 81%. But all the pressure that UPS has been facing has driven their current dividend yield to a 5-year high of 4.7%, which is one way to fast-track your dividend income and dividend growth by starting high rather than relying on future growth, as the growth has already been baked into the starting yield. Also, if you prioritize dividend safety through the dividend growth streak, they have proven themselves to be resilient through various economic times, with a growth streak of 14 years and an uninterrupted dividend streak of 55 years. So this may be the starting yield worth holding on to. Last, we see the TTM PE ratio is 19.9, which is a 20% discount based on their 5-year average PE of 25, indicating a solid value, despite their recent earnings decline. In summary of the fundamental analysis, UPS feels like a risky play with high potential if we assume they can hold on to their dividend. I recently took the risk and bought call option contracts under the premise that some dividend investors would be flocking to their yield, and we'll see in the next segment, I think some technical analysis investors are seeing a buying opportunity as well. Personally, I'm looking for a short-term price bump which will exit me from my position. If you want to see my buys and sells, you can find my Patreon linked in the description below, and there's currently a free 7-day trial. Now we see UPS on a 5-year time frame. The first criteria for potentially buying a stock I'm checking for is an uptrend for this period, which UPS satisfies. The next criteria is that the stock is trading below the average price, which is depicted by the center yellow line. The average price is currently $189, while the current price is far below average at $137, which is a 27% discount, which is quite a meaningful discount. The next technical buy criteria I'm checking for is that price is at a prominent support level, which it is, as price held this $133 level in October of 2023, although an even more substantial support level is around $123, which also corresponds with the bottom of the standard deviation channel. Price could fall to this level given UPS's declining fundamentals and the state of the economy. If price goes up, the next resistance level is well defined around $155. The last technical criteria I'm checking for is that the relative strength index signal line is near the bottom of the channel, or better yet, that there is a buy signal like there was in October of 2023. The signal line is near the bottom of the channel and has only reached this low level 4 times over this 5-year period. Another correlation that I typically look for is that the sector I'm buying into is also trading at a low price or at technical support. The ETF that has UPS as its largest holding is the iShares US Transportation ETF, ticker symbol IYT, which we see here. IYT recently reversed off a technical support level around $63. It's below the center standard deviation line, and the RSI is at a relative low. Although, as we can see in the past, when this ETF dipped, it fell at a greater degree than it is at currently, potentially indicating greater downside to come. Now we'll have to see what UPS does next. If you want to see another stock analysis video of a company that is currently trading at a massive fundamental discount, check out this video analyzing Ulta. If you've made it this far, thank you for watching until the end, and if you got value from this video and want to see more like this, I'd greatly appreciate it if you could leave a thumbs up. Full disclosure, at the time of this video, I'm long UPS stock.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.